Alright guys, Chef here on auctionmarkettheory.io with the auction market theory training course. We're in the price action and trade setup part of the course. If you are skipping ahead, you are doing yourself a disjustice here. Go ahead and go back and get the last 3 videos on the welcoming of the course, setting up your charts accordingly, and how to establish and understand the basics of auction market theory. Let's get started here. No representation is being made that the use of strategy or a system of trading methodology will generate profits. Past performance is not necessarily indicative of future results. There is substantial risk of loss associated with trading futures. Only risk capital should be used to trade. Trading futures is not suitable for everyone. Trades called are for educational purposes only. Any trades taken rely on a auctionmarkettheory.io by individuals are taken by their own risk and risk at their own account. Just trying to read that real fast. Alright, so like I said, if you haven't seen the last 3 videos, please go back before you do this video. It just puts it all in order for you to get a complete understanding. And how this ties in real quick, we'll get into that after this final video of the course. We don't need a chart to do this because according to auction market theory, if we look at the resistance line or value high, you can see it right here, and then we look at the support line or value low of a migration of a value area. So we have to look at it in 2 different scenarios. Number 1, or 3 different scenarios to be honest with you. If the market's flat and we're trading horizontally, how do we trade it? If we're trading in a downward migration, how do we trade to the short side? And then, of course, if we're migrating higher, how do we trade and look for trades to the upside? Okay, so again, look, value area high, value area low, and our midline would be here. Okay, so with that being said, let's just start if we were migrating higher. Now, we come into this area here, we have a support line. Are we taking the trade immediately off the support line? Now, how do you understand where do you get in a trade? Well, our trades are based on a price area. We trade value, not price. So what that means is you're not looking for a trade at 46.04 to go long. You're looking for an area to get long, an area to get short, an area to get short, an area to get long. Okay, what that means is yes, you can pinpoint on the 5-minute chart, you can pinpoint the price according to, you know, when buyers in the auction process establish when they establish control of the market at a well-defined area of support, which is our value low. If we're migrating higher, if we're moving up and the market is coming up and pushes down against value here, buyers take control. Okay, so if buyers are taking control in this area, you're at a trade level where your risk level is well defined based on this area of value low support. So your stop loss would have to be below the support line and a well-defined risk. So there's not really a precise price of getting long, and it is off the 5-minute, but what needs to be more precise is that well-defined stop loss. That's what's going to help you win more trades, with getting in at a trade at a well-defined area such as this value low in a hypothetical move that we're moving forward, long-term migration higher, that your stop loss is below, and now you're looking for longs off this area. So say you missed this long in the long-term migration higher. 9 times out of 10, the market will pull back against its prior support. If that support fails, that is another area of potential trade off of the value area to go higher in migration. Now, where do you place your stop in this instance? Well, it's totally up to you whether it goes below this swing or if it goes below the support. Depending on your risk factors and count size, that is what's going to happen for your trade. It could be where you got in the trade. It could be 3-4 ticks under the swing, or it can be 10, 15, 20 ticks below the support. It's depending on your trading style and your account size. Now, you have to understand the outcome of a trade, and these are other things that you can read on our website as far as the probabilities of trading and understanding that you are not in control of the market. The only thing that you have is a slight edge in the market. It's either going to work or it's not. Potentially, if the method is working more than it's not working, you're going to make money. If you are allowing your trades to move in a direction to where you soak up every tick, or you're getting out early, or you're taking large stop losses and small wins, it all depends on many things, which you can go look on our website as well under trading strategies. Now, 2 areas of trade off a migrating high. Support line comes down, gives a bounce, buyers take control, well-defined stop below the value low. You get on board the trade. You miss it, look for the pullback on exhaustion. Trade gives you another opportunity to get long when buyers take control. Same thing. Now, market's at the midline. Market pulls up, bounces off the midline, shows an imbalance to the downside. Do you get long, or do you add to your position? Well, that is a good question, and a lot of people, would be getting out on a pullback. A lot of people find this an opportunity to get long on another position. Other people find it, oh my goodness, I got long down here, I'm getting out. That's all different types of looks at the market, all different types of traders. If you got long, say down here, and hypothetically say this number down here is 50, and this market pulls back to 49, pulls back to, I don't know, 50.80, from 50.90 to 50.80, and you got along at 50, you're 70 ticks into the market. Do you give this market space, bouncing off the mid, and see if it recoups to the upside, putting your position profitable? And is it enough to be profitable to where you can add a position, take it as a loss, and still be profitable off your first position? That is also how far this trade went. It all determines how far you are into the trade as far as profit level, if you can add or not, or take profit, or get out, or whatever. So, that is a midline. This does not establish a trade from zero. This establishes a trade based on taking trades off of the lower value low, off migrating higher. That's where you would get long off of here, is adding to a position, not establishing your first trade. You missed the first trade if you didn't take it down here. Okay? And the same thing here, another imbalance to the downside. Now, looking at this, if we were migrating lower and the market made a bounce off of support coming down lower, and this is a huge pullback, and this is our daily value high, where do you get short? Well, it's the same scenario. If you're migrating high, we're now hypothetically migrating lower. Where's the short? Against a well-defined area. Here's your value. Where's the short established? When sellers take control of the market against a well-defined area of your value high, it's a well-defined area of risk. So you're getting short off of either, again, sellers take control, or based on exhaustion when sellers take control again. All depends on where you place your stop loss, behind the swing, or behind the swing, or above value. It all depends on what you're doing with your trade management, risk, trade size, count size, all that good stuff. Okay, so that's what we're looking at as far as value high, value low, migrating higher, migrating lower. Now, looking at the market as a price action standpoint, look at the areas of range. If we're migrating higher, here's the range, large range on the first thrust. Second thrust is smaller, third thrust is getting smaller, shortening of the thrust. What does that mean? That means the move is getting less and less, more potent to the upside, and you should expect the market to slow down, consolidate, turn around, whatever. That's when major profit taking will happen. People establishing short positions will happen. All that stuff will happen at that point. Nothing can happen. It can just consolidate, and you'll see short-term profit taking happen, consolidation. The market starts to bounce around in its horizontal phase again. Or you can see that you're looking for the short at this time in a downward migration here. You can see it. You can see that the market, you're looking for the short based on shortening of the thrust, as you see. We're in a market that's migrating lower, hypothetically. And now the trade establishes on the exhaustion point based on the shortening of the thrust here, coming to a no-brainer that the buyers are not evident anymore, and that the short should be established with a well-defined risk above the swing or above the resistance line or value high. Okay, so what could happen in a downward move? Again, moving forward here, there's always buyers that are interested in buying at these levels because it's moving out of an area and showing a potential breakout. What do we get? We get the false breaks with an upthrust where the bar itself shoots high and then closes at its low. It's like a vacuum cleaner grabbing all those wrong-footed buyers at the top of a market, and they're like, what just happened? Okay, so at that point, if we're in short-term migration, right, the market's migrating low, guess where we're getting short? Here's the upthrust. Do you take the short off the upthrust? No. Wait for the upthrust to be tested, okay, against the value high. Once you see this, it try to test that high and fail, guess where you're getting short? In a short migration to the downside. You guessed it, right in this area here with a well-defined risk above value or above the swing of the upthrust. It all depends, again, on your factors. Same thing if we were migrating higher. This is called a spring, where the market shoots down below value and then closes on its high. Watch out for springs and upthrusts, because if the range of their candles are large, their potency to the downside or downside for upthrusts and up moves for springs can diminish, because it's all based in that candle already. There's nobody left to continue the move. So it has to be kind of a well-contained spring or upthrust. Don't look for those huge ones and go, oh my God, this market's going to take off, because that's not what happens. Okay, there has to be people or trades left over after it closes in order for it to actually make that potent move. So, support line migrating higher, the market shoots down, all those wrong-footed sellers, oh yeah, I'm getting short, the breakout happens. Then all of a sudden that market closes on its high, or excuse me, that bar closes on its high, creating the spring. The vacuum cleaner took in all the sellers, and you get immediately long on a spring. Upthrusts are potent in a downtrend move. Springs are more potent in an upward move. So if the move's already moving up, then a spring happens here, then yeah, you could possibly take the move off the end of the spring to the upside. And then if the market is moving down and an upthrust happens here and the market's moving downward momentum, yes, then the move can be taken off the spring, off the upthrust. But if the spring happens here and you had some price action in between value, but the market is migrating higher, you want to test that spring right here. Okay, that's what you want to see what happens. All right, so at that point, again, you establish your well-defined stop loss, not your trade entrance, because your trade entrance is basically when buyers take control. At that point, your well-defined risk is on your stop behind the swing here or under the spring. Again, that all depends on your factors of trade. Now, there's another way of looking at this. the market is trading horizontally, or if the market has made, if it's migrating, if it's been migrating higher, right? And then this is the first migration box or value area that's traded higher, lower. If we're migrating higher, and this is the first box that establishes a lower area value, then the trade comes off of the prior value area that you see here, test the range extension right here, and look for, see how it comes down the market, see how it comes against the value and exhausts itself. You look for the short based on exhaustion when sellers take control. Guess where your well-defined risk goes? It goes behind value low. Okay, so that's what you're looking for on this end of it. And then, of course, if the market is migrating lower, makes it first area above a new value area above the lower value area, you're looking for the same thing on the opposite side. You're looking for it to bounce off value high, test a range, and it bounces, or you see buyers take control off of value high. Guess what you're going to do? Buyers take control, stop is well defined below value or below the swing. All right. Now, two things can read potential breakout as well, and momentum trades off of value areas when they're migrating up, for instance, would be here. Remember, the market moves horizontally or vertically or in balance and price discovery, however you want to use the terminology. If we're migrating higher on a well-defined migration, yes, would you like to take the trade off of absorption off the high here? Absorption usually means higher. In this instance, if we're migrating off higher and we're pushing against a value area, and the lows are getting higher, but the price is still absorbing against this line here. There's no downward follow through at all. It's all pushing against that value area. It's holding strong at the moment, and it's like, you just see the volume itself getting stronger against the line there. Right in this area, you get that break. Now, yes, we want to take price discovery or the vertical move on an upward migration from value high. Yes, that is where we want to trade. Where does the stop go? It goes below the swing or below value, depending on your risk factors. Okay. Again, what happens if that break does not work and you're in the trade itself, but your stop is below value? You can either take small profits, stay in the trade, look for prices to revert against the value line, look for confirmation of exhaustion. Number one, stay in your trade. Number two, if you got out early, look for the established trade when buyers regain control of that level again and get on board that trade. Same thing on the downside with absorption to the downside. The same thing will establish. The highs will be lower. It'll absorb against the value low. Look for the spring right here towards the area where it pulls back, and then all of a sudden vacuum cleaner happens to the sellers, and then boom, it takes off to the upside. And then same thing against the low here, off of value low. It'll create an up thrust, and the market will absorb immediately against the value low, and then you see the seller's volume take control. That market will rocket through that level pretty darn fast. So that is potential. Hypothetically, the market's migrating higher. We're looking for price discovery or migration higher. This is where we're trading on a well-defined area of risk. If the market is migrating lower, we're doing the same thing but mirrored to the downside off of this level here, getting short with a well-defined risk against value low. All right, so that's how we look at the markets. That's how we look for our trade setups. If you join our live trading room, we do the market itself in a squawk box style, where we're calling basically the market on every buy and sell tick. So we kind of understand what buyers or sellers are doing at certain price levels, and we see who's taking control of the markets at what price, and we trade accordingly. How this ties into the rest of the course, of course, this is the completion of the trade setups. To get ongoing education with this, if you're not a member, we do live training once a week where we take scenarios of every week and we go over the different aspects of the auction market theory, trading methodology, and take it even further for what's happening at that typical day or week. So your training and your development is based on the now of what's going on in the market's behavior as of right now. So if you'd like to join, go to our website if you're not a member and go under join us, and you can see that we have monthly memberships there and other memberships. Any questions, comments, or concerns, you can contact me at chef@auctionmarkettheory.io, and I'd be glad to answer any questions that you may have. Please go to our website, visit our information, share this information if you can, become part of our social medias like we have a Facebook, we have Google Plus and Twitter, and of course, if you're watching this on YouTube, please subscribe to the videos that you see. All right, guys, take care, and we look forward to see you in the live trading room. Bye-bye.